Welcome today to our first ever webinar on financial concepts. My name is Viren Parmar, president of Karma Financial, and I'm here today to talk to you about time value of money, one of the most often overlooked concepts of financial planning. The idea behind time value of money is basically that the value of $1 today is not the same as the value of that $1 in 10 years because of inflation. Everything rises in terms of price, whether that's goods, energy, food, clothing, shelter, etc. That same dollar of $1 that you may keep or store under your mattress will not be able to buy you the same amount of goods in 10 years. That being said, there are things you can do to deal with inflation, which is what's behind this idea of time value of money. To illustrate the concept further, we have something called compounding. This is the concept of foundation about any type of investment. You want to make sure that your money is growing to keep up with not only inflation, but other aspects of your financial planning needs. Because again, that same amount of money that you have today will not buy you the same amount of goods 10 years down the road. Even if you have a lot of money stashed away somewhere, that money will erode in true value over time. However, investments, whether you're new or experienced, there are options available to you that can alleviate that problem. The idea behind compound interest is whatever you invest in, you will grow that money over time. That money can be invested in anything from stocks, GICs, term deposits, real estate, cryptocurrency. All of those things have a potential risk and return attached to them. Depending on what you invest in, it goes up or down in value over time. In theory, most things you invest in should rise over time. Things like the stock market, bonds, GICs, etc. The idea behind compounding is that that money, that $1 you put away today and invested, will, in theory, grow over time. And if you do it right, will keep up with and maybe even exceed inflation. To illustrate, here is a graph that you can see that shows the idea and power behind compound interest. Early on, your money may be very small, depending on what you invest, and usually will start very small, but over time, that money will continuously grow. Even if you decide not to put more money into your investment, even then, you can see over time, depending on how long you put your money in, it will grow over time and grow exponentially. This is because the interest that you're earning is not only growing on the original amount you invested, whether that's $1 or $2 or 10,000 or $1 million, but it's also growing on the interest that's being earned each year. This is the idea of interest on interest. The yellow bar is essentially what you invested, and the purple bar is the interest on interest. As time grows, you can see that the purple bar actually is growing bigger and bigger compared to the yellow bar. And so over time, the longer you have, you can see you can build up quite a bit of an investment in, let's say, 40 years. The idea of compounding is affected by three factors, one being the interest rate. The higher the interest rate, the higher the potential value that you can grow your investment in. Obviously, an investment that pays 15% a year is going to generate a higher value than some investment that only generates 2% return each year. Also affects this compounding is time. The longer you have time to build that investment, the more potential value you will have at the end of that investment time horizon. As you can see again in the chart, an investment that has a 40-year time horizon has a much higher ending value than, say, investment with only 18 years. And this is because you're allowing your investment more time to grow and more interest to compound. This is very critical for anyone at any age. It's never too late to start investing, but the sooner you start, the better. It is highly recommended that you invest as young and as early as possible because of the power of time value of money. The other factor that factors into this idea of compounding is the tax rate. The higher the tax rate, the lower the potential rate of return. And so this goes along with the idea of tax sheltered accounts. If you're in an RSP, you're tax sheltered, more income is sheltered from taxes. And so your investment can grow at a higher rate than if you were paying high taxes in an open non-registered account, for example. The taxation does eat into the rate of return. So it's always advantageous to look for ways to save and minimize your taxes on your investments. There are going to be future webinars that will go into more detail into the aspects of taxation, but I just wanted to summarize that taxation will have an inverse effect on your rate of return and ultimate present value. The higher the tax, the lower the return. RSPs and TFSAs are great vehicles to invest in if you haven't made use of them already. But if once you've exhausted that, then you have other vehicles that you can explore. Looking at compounding another way, let's say you have $1 million to invest and you want to see how much time it would take to reach that goal. You want to see at various amounts invested, how much time it would take. So looking at the chart here, as a comparison, the more time you have, the less you have to put in to reach that goal of 1 million. The idea is even a small amount over a long period of time will generally outperform an investment where you have a very short time horizon, but you have a lot more to put in. As you can see, a time horizon of 15 years requires you to put in 33,800 a year to reach that goal of a 1 million. And we're assuming a rate of return of 7% in this example. That means that you would have to put in over time a total amount of your own money of over $500,000. Now, if you had 50 years to make up that investment, then you would only have to put in $2,150 a year, far less than the original scenario. And over time, you would have put in only $107,500. So you already have put in a fifth of what you would have had to put in if you only had 15 years. Whereas if you have 50 years to build up that goal, you would have to put in a lot less. Again, this illustrates the value of compounding in that the longer time you have, the more you can compound and generate returns to build up that same goal of 1 million versus having a shorter time horizon. There are other concepts that go into it, but this is a simple example I just wanted to illustrate. You can look at things like borrowing and, of course, factoring taxation, but for the most part, the shorter the time horizon, the more you have to put in to reach the same goal compared to a longer time horizon. That's why, again, it's very advantageous for someone young who may not make a lot and may not have a lot of savings to consider putting in a small amount to generate a rate of return compared to someone who is much older and may have a lot more wealth and certainly has the assets, but may not have as much time, and they would have to put in a lot more to reach the same goal. Another way to look at it is over a 10-year period. If you put in $1,000 and you assume a rate of return of 10%, again, this illustrates the power of time compounding over longer periods of time. if you had a time horizon of 70 years, using the same investment approach of 1,000 a year at 10%, you will have generated close to $1 million, just under 800,000 in that 70-year time horizon. Whereas over 10 years, you would have only reached an investment value of 2,600. So that illustrates the aspect of the time horizon. Now look at another example. Let's say that you have two people who graduated from college. One is 25 and another is 35. In this case, Jessica, who is 25, just graduated. She only has 5,000 to invest, whereas Newman has twice as much at 10,000, and he's 35, so he's 10 years older. And they are both now starting at the same time to invest in something. And let's assume they invest in the same thing at the same rate of return. Now, over the course of time, and let's assume they both want to retire at age 65. So that leaves Jessica 40 years as a time horizon, whereas Newman has 30 years in that to reach that retirement goal of age 65. Assuming they continue to invest each year, Jessica can only invest $2,500 a year because of her current age and status and wealth, whereas Newman has a little bit more, so he can invest twice as much. So again, let's assume they both start at the same time, but Newman has twice as much to invest and invest twice as much each year until they both reach age 65. As you can see from the graph, when they both reach age 65, Jessica, in fact, ends up with a higher value in her investments compared to Newman. And again, that's because her time horizon is 40 years versus 30 years for Newman. So she had a higher time horizon and more time to build up the same retirement income fund that Newman had. It just illustrates again the importance of starting early and investing early compared to waiting until you think you have more money. That's one of the biggest misconceptions that a lot of people have, is thinking that they need to wait until they have a little more income before they want to invest. It's always recommended to start with a little bit at an early age and then increase that investment as time goes and you have more wealth to invest. So that concludes the idea of time value of money and what that means. Again, the idea and the main importance of this is to keep up with inflation. But aside from inflation, this also allows you to build your wealth portfolio faster than if you kept your money in cash. Thank you very much.